We're gonna now move on to a very different theme and someone we've done at least, I believe, almost 10 webinars together. But now it's a very interesting time where every time we do an event together with Andrew, there's something that's brewing. There's a certain message from the media that we want to demystify, we want to break down. So with that, Alex, if you can just please add Andrew to the event. Hi, Andrew.
Hey, Mark. How are
See
you?
you. How are you? Good,
Really
good.
well,
And you?
thank you.
Awesome. Hope you enjoyed a bit of that if you were able to follow, as a very different investing than what we usually talk about, a much earlier stage. But yeah, excited for this one.
Yeah. That was really cool. That was cool to sit in on that, and you know, especially as it linked to Sarwa specifically. That was pretty cool.
Great, great. I guess, Andrew, I have a lot of the data you showed me, and I know we're going to do a deep dive on a topic that we've been getting so many questions and fear, as you can imagine, around the dollar and what's happening. And when gold is shooting up, or there's popularity around gold, it's time for us to do a webinar together. But before that, I want to just ask you maybe just two questions for more of the newer investors that are thinking of starting out with investing in ETFs in general. And I wanted to hear from you. One thing I really admire about you is that you're independent, and that's why a lot of people look for you, look up to your books and your content, is because as Sarwa, we do well when people are investing. In your case, you're educating and giving back a lot in terms of the data, the research. And the first question I wanted to ask you is, why invest in the first place? What is it that drives you to get people invested? There must be something there that propels you to encourage people. So I wanted to help people that are maybe sitting in cash at the moment or thinking of investing. What would you say to someone that's thinking about it, on the why behind it?
Well, on a long-term basis, it's the best way to beat inflation and to gain financial independence. And financial independence gives us so many choices. And everybody's value system is going to be different depending on how they choose to use that time when they're financially independent. But you're never going to be younger than you are right now. And so the more time that you have in the markets to start investing, the better. So if you're thinking about doing it, invest right now. Invest as soon as you can, and then going forward, as often as you can. Continue to add money.
And once we've done that, what do you see? What do people get wrong along the journey? What are some of the common mistakes once they have started investing, they are contributing regularly? What are some of the behaviors or things you observe?
Yeah, it is behavior is the huge one. So when we look at, typically we look at investment portfolios, whether they're ETFs or whether they're actively managed mutual funds, it really doesn't matter. When we look at, it does matter, it's better to go low cost, of course, but when we're looking at the behavioral component of it, what is so fascinating is it doesn't matter whether it's index funds, ETFs, or actively managed funds, the typical investor underperforms the funds that they own after fees. And it's not because of the fees that they underperform them, it's because of their behavior. So if I look at any fund, I can look at any fund, I can look at Morningstar's results on any mutual fund I want. Let's say over the last 15 years, we'll pick some fund and we'll look at it, and let's say it averaged 8% per year. And then when we do a cash flow analysis, or Morningstar does a cash flow analysis by getting information and data from the firm to see when was money being added to that fund, when was money being pulled out of that fund, they can actually get a pretty good assessment on how the average investor performed in that same fund. And so if that fund averaged a return of 8% per year over 15 years, then if people were rational, they would have earned about that. If they had been investing in it for 15 years, they would have earned about 8%. But unfortunately, people aren't rational at all. So typically people are going to underperform their funds by, if we were looking long term, especially when we started looking at periods that go through both bull and bear markets. So when I say bull market, it means a period where markets are rising. A bear market would be period that's flat, or a long-term period that's declined for a bit. When we span that, we find that most investors will underperform their funds by 2 to 3% per year. Now, it doesn't sound like much, but that over a lifetime is massive. And it doesn't matter whether you're an index fund investor or an actively managed fund investor, most people do that. So we look at their performances, and I've published the data that I've got from Morningstar on the S&P 500 index. And the typical person who's been investing in that thing for the last 15, 20, 25 years has actually underperformed it by about 2.5% per year. So one of the things that we do as people is we chase things. Like, you might, one of the things people did was, you could take an example of Cathie Wood's ARK Innovation ETFs. And people saw that, wow, they're doing so well, I'm going to buy those. And when they're buying those, they're not putting as much money into, maybe it is their S&P 500 index. Like, so they're basically chasing their tails. And we end up doing this typically buying high and then not adding money when we have a low. Or we look at forecasts. So people will say, well, geez, I'm kind of worried about the US market right now. It's dipped, or, maybe the US dollar is falling, or the euro is falling, or polar bears are not producing right now to the degree that they should be. And so there's a knock-on effect. Okay, I made up that polar bear bit, but whatever it is, it's just as ridiculous typically as the next. And people end up not adding money during times when they think that something is going to happen that will benefit them to hang on to their cash and invest it at some point in the future at a better time. Some people foresee that, quote, better time being when markets rise. So the better time is waiting for prices to rise. And other people will see it as, well, no, I'm pretty savvy, so I'm going to wait for markets to fall. I'm going to hold on to my cash because I think markets will fall. And then they don't. And so then that person is lost out on capital appreciation when the markets end up recovering, and the dividends that they would have ended up achieving through the process of just close their eyes, invest in that globally diversified investment portfolio, add money as soon as you have it, and as often as you can.
That's really well said. Thank you, Andrew. And I guess that leaves us to what I want to focus on with you today. And for a bit of background, I emailed Andrew not that long ago, actually, as soon as I started to see the media is doing its thing, and there's a lot of fear at the moment. There's a lot of people asking me about gold. There's the story around the changing world order and the US losing its grip. So all of these signs where we're starting to see that developing on Twitter, on the media. And of course, to Andrew's point, if we see that there's a behavior gap, you can imagine the impact of information that's clouding our judgment and having us stay more in cash. Or this is similar to staying in cash, but it's starting to think, all right, things are about to change. Maybe I should overweight other geographies, underweight on the US, start to do some currency conversion, and that can lead to a lot of that behavior that is unwarranted. So the purpose of today isn't to predict the future with Andrew. I didn't ask Andrew, what is your view on what's going to happen? The ask is, what is the data telling us today that could either support the story or, on the contrary, disvalidate it, and so that you as an investor can be more informed in whatever you decide to do. So with that, I'm just going to share my screen. I want to send, this is a tweet that I sent Andrew to see, what do you think about this? Where we saw Stephen was saying, my barber was just telling me about the collapse of the dollar and how China, Russia, and Brazil are going to remove it as their reserve currency. And Nassim Taleb, who wrote The Black Swan, someone I really admire, tweeted back, you will only start worrying about the dollar status as a reserve currency when you see long lines outside the Brazilian, Russian, Iranian, and Chinese consulates full of young professionals seeking immigration visas. So you're starting to see a very different view than what's happening at the moment and the type of panic. So I guess before we go into the data, Andrew, on what's happening and how what's the impact on currency, on portfolios and things like that, I want to hear from you. Is this anything new, or is this something you've observed as a story a couple of times where you see some panic around the US dollar and the US losing its power?
Yeah, it's funny. I have two things to say on that, Mark. And one is, I mean, as you know, first of all, this is my 34th year of investing. And especially when I first started to invest, I was definitely glued to headlines. And so, yeah, and of course now my job is basically writing about investing. And so I'm always looking at data and getting a firm understanding on how I can explain things as best as I can to the people I'm speaking to and the audience I have as I'm writing. And the decline or the demise of the dollar is something that news media picks up on every few years or so, and I've always seen it. Every handful of years, there will be articles about it. Well, what's interesting about this one, to me, Mark, is that algorithms will target specific people in terms of the news. Like when I Google, or I go onto a news, when I go onto the internet, I'm going to see different things that you're going to see. Like, things are going to pop up about Roger Federer, what he's doing now in retirement, and Novak Djokovic, because I love to watch tennis. And I'll get a lot of data related information related to finance, and this whole fear about the dollar. I hadn't actually seen it this time. Where I would see it would be on like Facebook groups, and and so I know like Simply FI group, and then a couple of Facebook groups that I'm members of. People started asking this question and asking me, and I'm thinking, I didn't even see that this time, which is pretty interesting in itself. It's like, what are you actually looking at for the algorithm to target you on this? So I actually had to dig it. I had to look for it. Oh, okay, look, I can see, the media's kind of at it again. I kind of call it fringe media in this case, because usually when these stories emerge about the demise of the dollar, and they do, like, every 4 or 5 years, you'll get these stories, and media start, hey, we can start picking up on this, and fear sells. It sells really well, and of course the media in all of its forms gains money from eyeballs, and the more eyeballs it draws, the more advertising dollars it draws. And the research on this is super solid in terms of if we can frighten people, if we can make people afraid, fearful headlines actually grab eyeballs far more prolifically than neutral headlines do. So if you can grab someone's emotions in a way, then we can run with that. So you'll see some of these media networks now running with, again, the demise of the dollar story, which I found pretty interesting, in that usually I'll see those stories after the dollar's had a big decline. And like currencies, they don't continue to rise. You don't make money from currencies. Currencies as a group move up and down. It might look like you can make money with them if you're looking just short term, but if you're looking over like a lengthy period of time, like a 25-year period, you'll see currencies moving within a band, and they just kind of float within that band up and down. And that band, it could drop, a specific currency could drop for a few years, and it rises back up against other currencies, and it might drop for a few years and it rises back up. But it stays, typically, especially developed market currencies, stay within a fairly narrow band of each other. And so the idea of this dollar demise thing, coming at a time when the dollar is at like near a 10-year high against virtually every global currency, is a super tough sell. I've actually found it kind of funny. Like, wow, these guys are trying to push the decline of the dollar now. It didn't make a lot of sense. I thought it's a lot easier to do that, scare people most efficiently. I'm thinking of it from a journalist's perspective after the dollar's had a big decline. So it's a tough sell for them right now to try and sell people on this. But yeah, nevertheless, they're still trying to run with it. And people who aren't familiar with the media, what its prime directive is, they're not familiar with generally with currencies. They can, especially if they're relatively new investors, be afraid and then start spreading these stories, which is pretty fascinating in itself.
Mhm. Yeah, and I think, as you said, it fear sells, and I want to go through before we, yeah, I want to go through some of the data once you've seen that story develop that was maybe outside of your immediate um, newsfeed. What are the things you looked at? And I think one of the things you started with is looking at the dollar gains against other currencies.
Yeah, the demise of the dollar. It's a story that sells far better when the dollar's actually has been dropping. But over the last 10 years, you can see the dollar compared to virtually all major global currencies is up. It's up 11% against the won, 16.8% against the euro. It's up 23% against the British pound, 53% against the Australian dollar. The Russian ruble, it's up 160%. You can see the Swiss franc, it's down 5.4%. Again, nothing too worrisome there. And you can see it's up 25% versus the Canadian dollar and the Japanese yen. The US dollar has gained 37% on the Japanese yen over the last 10 years. So holy smoly, like I don't see it too often in terms of this kind of run on a currency where it's got very strong against other global currencies. Okay, that happens, but when that's coupled with stories about it collapsing or the demise of it, it's actually kind of silly and amusing.
Mhm. And define here, I think you sent me the dollar's real value has risen during the past 10 years. So how are you looking at real value in this context?
Yeah, they'll just look at like inflation adjusted relative to other global currencies. So this is just even a broader aggregate. So the table that I showed you is me just hand picking what I felt were, the major currencies of the world: the euro, the Canadian dollar, the pound, the Australian dollar. And this represents real after inflation terms in basically all global currencies. And so
Mhm.
you can see that it is significantly higher than it was 10 years ago. So yeah, the US dollar, has actually gained ground. It doesn't mean that it's not going to, drop and move back into what might be a normal range. It might not. But the idea of these stories talking about the demise of the dollar when it's a pretty solid ground is pretty interesting.
Would you say the danger in misinterpreting the headline is, I guess, what would you say it's accurate to say it's possible that this can happen in the future where we see the rise of a new power, but the danger is getting the timing wrong and starting to interpret this as a signal to you having to reallocate your portfolio. Is that it?
Yeah, and when we talk about investing, here's one thing that was really interesting that I found just looking at forums. And forums are really a good gauge because they can tell me, what are new investors thinking? Like, what's their fear? So,
That's
first
right.
of all, we can say a global stock market ETF, and they'll say, well, my global stock market ETF is priced in USD.
Mhm.
So it's an investment in USD. And so if the USD drops, then the value of my ETF will drop because the USD is dropped. That's not true. The idea here is that if you own a global stock market ETF, you own the world's currencies. You don't own the US dollar. Even if it's priced in US dollars, it doesn't mean anything. It could be priced in pounds, it could be priced in yen, it could be priced in euros. It's completely irrelevant to your overall returns. So, if you convert your returns into any common currency, the return, whether it's priced in pounds, Australian dollars, Canadian dollars, or USD, if you convert the returns into one common currency, any common currency, you'll see that the global stock index will have the identical return. So
Mhm.
it's an investment in the world's markets and in the world's currencies. It just happens to be priced in USD. So, I give the example here, Mark. Let's just isolate it. Let's take the US component out of it and just talk about an international stock market index. Let's say it's international, developed market plus emerging market and no US. So let's just say it's got no US. So let's say someone just owns that in isolation. And let's say over the next year, it goes nowhere. It's just basically flat. The markets are flat. But let's say that over that same year, let's say the USD declined by 50%, and this thing is priced in USD.
Mhm.
So what people say, wow, it's priced in USD, so it's an investment in USD. It is not investment in USD at all. In fact, it doesn't have any USD in it, even though it's priced in it. So what would happen is in a year when it was flat, if the USD dropped 50% relative to a basket of global currencies, in USD, that ETF would have gained 100%. It would have doubled in value because the currency would have got cut in half, and that's the currency that you're actually measuring it in. So I think it's super important, Mark, for people to remember that when you have a globally diversified investment portfolio, you're investing in the world's markets and the
Mhm.
world's currencies. That's the
That's
most
a big
important
one.
part. Yeah, the
Uh,
safety of just
uh,
it's the safety of overall diversification.
Especially when there's so many, when the finance industry is already so complex between the brokerage, the advisor, the custodian, and the portfolios, and to add on to that, are having to worry about the currency. I hope that's a weight that's lifted for the people listening, where we can focus on the ultimate holdings. And to give that, I'm just going to skip a bit to give a real life example that Andrew looked at, which is if you look at, I think here what you were showing is the one of the big US dollar declines, where despite it losing double-digit losses as a currency, US stocks still gained more than 200% in 15 years. So that's just to go from your hypothetical example to some of the data you showed reflecting back on early 2000s.
Yeah, there's another. So here's a point in time where the US dollar did drop. So a big drop began in 2002. And you can see how I've compared it here to the world's major currencies, the Chinese yuan, the euro, the British pound. So the US dollar, just as you can see the euro there, just use that as an example, the second one down. The US dollar dropped 39% relative to the euro from 2002 to 2011. That's a pretty big drop. And you can see it dropped, how much it dropped relative to the Canadian dollar and the Australian dollar. Huge drops over this time period. But over the 15 years that followed the beginning of that drop, this wasn't a 1-year drop. So everybody keep in mind, this was from February 2002 to July 2011. So, you got about a 9-year period where it, bubbled up and down, but generally the trend was downward. But if you just had, the US stock market index, and we'll isolate it. We'll just say the US stock market index price in USD, and that literally is, it's an investment in US currency and the US market. And if you'd had that investment in 2002 at the beginning of the decline of the dollar, 15 years later, it would have tripled in value. It would have gained 200%. That is a triple, by the way. 100% is a double, 200% gain is a triple. So, even the idea, if you own a US stock market index in isolation and the US stock market drops, it doesn't mean that you're going to all of a sudden have horrible future market returns.
Awesome. I want to close off with this one that I really liked as a chart where you looked at, all right, well, what are the other countries doing with regards to US treasuries, and to
Mm-hmm.
also see that activity. So I really found it, yeah, I really liked that you looked into that, and would love to hear maybe some comments on this chart and what it's showing.
Yeah, if you're looking at like confidence in the currency, this spells it out better than anything else. It's looking at foreign countries and what do they own in US treasuries. So U.S. Treasuries is essentially it's in U.S. dollars. So this is probably the strongest testimony to the confidence that people have in the U.S. dollar, is that you can see global institutions, foreign institutions, have been adding money to U.S. Treasuries over the past 10 years, not taking them away. So, if they felt that the U.S. dollar was something they couldn't trust, that there was going to be a demise in the dollar, we wouldn't see them actually adding money to U.S. Treasuries over the past decade.
Yeah, it's a way to follow where the money is going, also to back that their own views and not just the media.
Right.
Awesome, Andrew. That's been really, really helpful to dive into that. I guess one that's I would love your view, maybe more personally, as it's an interesting one that we get, where the way we do things at Sarwa is in a diversified portfolio that's globally diversified. And one thing that I've always found peculiar is when you, and this is something I know you all, well, someone you've actually met, I believe, Warren Buffett. And when it comes to Warren Buffett's allocation, of course, he's an outlier, and so it's important not to mimic his own activity all the time. But he will go after and say, he'll go as far as saying, he would put his money in the S&P 500, and there's foreign exposure in the S&P 500. So this is a question that is coming up less now, but let's say we've restored and we've addressed the dollar and the US dominance at this point in time. But what do we say, and how do you think about S&P 500 versus a diversified portfolio, given there's really credible people that are backing each one? So would love to hear how you think about that one.
Yeah, that's an awesome question. That's a great question. If you're looking at just the S&P 500, so one of the arguments to that is, oh, you don't need global diversification or international diversification if you own the S&P 500, because the companies within it sell largely overseas as well. So we can give the example of Coca-Cola. So Coca-Cola, 70% of Coca-Cola's revenue comes from outside of the United States. And so you could say that Coca-Cola is an international company. Absolutely. And that's absolutely true. But there's a slight difference here. The Warren Buffett doesn't really care too much about volatility. Actually, he doesn't care at all about volatility. He could care less. Doesn't affect him at all. Like his blood is gold when it comes to that stuff. He does not care. In fact, if the market's dropped, and he said in 1974, he was so happy. He felt like, this is his quote, "I felt like an oversexed man in a harem." Most Sarwa investors would not be happy to see their portfolio drop by 50 or 60%. Warren Buffett would be absolutely thrilled. Absolutely thrilled. Because that would mean more stuff for him to buy cheap. He's thrilled. The average investor, no. So the average investor should diversify further than the S&P 500 for a couple of different reasons. One that's really important is to know that price to earnings ratios go in and out of vogue. So I'll give you an example. The US market right now has, and has had for a few years, very high price to earnings multiples. It's expensive. It's an expensive market. So the stocks in the S&P 500 relative to the earnings that those businesses make, especially before the decline, we had a nice recent drop, and I call it nice. That was kind of nice in 2022, where things got, nice and reasonable again. So we're getting a better deal. But the PE ratios on US stocks were pretty darn high. And international stocks were low relatively. And so one of the beauties there is that when you're looking at something like, Robert Shiller would look at a CAPE ratio, and he would look at average levels of price to earnings multiples in a really strict sense called the cyclically adjusted price to earnings ratio multiples. And he would say, you know what, with earnings multiples lower in international markets, it means that overall they've been like the dark horse. They've been the one people haven't been paying much attention to. And statistically speaking, when PE ratios are low, prospects for future returns is actually higher. And so all of this being said, let's just to make this super, super simple, It's to decrease the volatility of the portfolio. So even though many companies in the United States in the S&P 500 have got huge international exposure, like companies like Coca-Cola and Pfizer and Johnson & Johnson. So you could say, yes, in a sense, the S&P 500 is international. It is, however, once you start adding an international component to that very specifically, building the globally diversified portfolio, you reduce the volatility. Warren Buffett doesn't care about volatility, but I can almost guarantee you, Mark, that 99% of Sarwa's, Sarwa's investors would, even though they might verbally say, I can handle a big drop, be a bit afraid if their portfolio dropped by 50% and stayed down there for 2 or 3 years. Buffett, So global diversification reduces the odds of a portfolio falling as far. It reduces the volatility. And when we can actually harness our emotions, and it's back to how we started this whole thing, the behavioral component, and how huge it is, this sort of diversification allows us to harness our emotions, ensure that we don't freak out, ensure that we continue to add more money. And that's why I firmly believe that 99.9% of people will end up richer as a result of always ensuring that they remain fully globally diversified.
Thank you so much, Andrew. Let's end with that. That was an awesome conclusion to today's webinar, and really appreciate you addressing all of these questions.
Yeah, my pleasure, Mark. My pleasure.